What's going out there? It's February 16th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. So it's Wednesday, which means I'm bringing in smartest, handsome guy in the world. I was waiting for you to talk because you think it's you, Daniel. That's Daniel Creasy, analyst. I mean, we break down the headlines and go over share different ideas and stuff, and a lot going on in the markets, right, Dan? I mean, a lot of news, especially over the past week.
Yeah, absolutely. We could start. There's several. We have like a Swiss Army knife today. There's several places we can start. We can talk about a moral victory for us humans with the face coverings that some big companies have announced. Or we can go into earnings or 13Fs. It's up to you there, Frank. What do you? And you inspired me to get a haircut. Look at that, people. Frank's leader by example.
I know. I got you got to see it. It was so short. It's actually growing in finally now. But
yeah, you're looking. I recognized you this morning. Last week, I was a little nervous at who I was working for.
A little bit. I look a little bit like a skinhead. But yeah, now it's growing in a little bit, and I'm getting over my cold finally. It's not COVID, but yeah, just going around and nagging a little bit, but getting better by the day, and hopefully you probably hear that in my voice. But you know what? I want to start really with inflation here, because we've seen a couple of numbers come up, and we saw the CPI come up last week, which was hotter than expected, and everyone was saying, well, it was expected to be hot. But now we're looking at a lot more numbers are coming in, right? So we're seeing import prices up 10% year over year. PPI numbers were insane, right? So producer price index. And now we're seeing a lot of companies talk about this as well. And I guess the question I'm going to pose to you is this priced into the markets? A lot of people believe this is priced in. I don't think it's priced in. I'm going to explain why and have details why it's not. But what do you think?
Well, give me some more detail. What do you like, inflation continuing at these same paces? Because some of those numbers that came out today were a little lower from their peaks, which is kind of the market's kind of taking that in stride, right? Mm-hmm. I don't have that right in front of me, but I remember seeing some headlines, hey, this is good because it's down a little bit, but we're still talking about very elevated. I think the market is pricing in higher inflation for the longer term. Yes, I do think that that's there. We can get into interest rates and how much we think that'll apply. But yeah, for the most part, I think people are gearing themselves for higher prices across the board as the new normal.
And that's the thing. We're all expecting higher prices across the board. For me, I'm expecting much, much higher prices, and I think the Fed is really has to be nervous right now. I mean, you're looking at lumber prices. I don't know if you're paying attention to lumber prices. So since 2010, prices average around $300, $400, and in 2021, prices surged. They peaked in May at $1,700, which is insane, right? $1,700. It was like, oh my God, look at lumber, and then they collapsed. And from May to December, they went back to the 450, 500 level. Today, they're back up to 1,300. So they doubled in 10 weeks. I'm going to bring up a chart here. So if you're watching this on a Curzio Research YouTube page, you'll see it. If not, I'm going to explain everything. But I wanted to bring this up. And I mean, this is incredible. So this is for the year, Daniel. Okay. And I have this up. So this is this year, right? So we're in February, right? Mid-February. Crude oil up 53%, natural gas up 40%, gasoline up 50%, heating oil up 56%. I mean, you're looking across the board. You can go ethanol, you can go propane, uranium, methanol. But I mean, the prices that have gone up this year, and then you're looking at lumber, you're looking at import prices. We know it's not transitory, but I thought we would be seeing more of a decline here, and we're not. And retail sale numbers came out, and they beat pretty easily, but it wasn't broken down to where are they selling more products, or is it just because they're selling at higher prices? And I really want to see that. So, when I look at the full picture here, I think the Fed is incredibly behind the curve. I think 50 basis point hike next month is a guarantee. I think we see another 50 basis. I mean, we have to go 100 right away, and we'll see. But for me, I love the argument with people saying, well, the Fed, they're not going to do it. They're not going to crash the markets. It's not a choice of they're not. It's they have to now. I mean, that's how much money they put into the system. It's resulting in runaway inflation to the point where, there's two companies, a bunch of companies will come out, but you're looking at Heineken. Heineken came out and said it's going to be hiking prices to offset significant and off-the-charts inflation. But the company wants this could lead to reduced beer consumption, right? This is whatever product you're talking about, right? So you're going to raise prices where people are going to be like, oh, I'm not paying for that shit no more. So he said there's no model that can handle this kind of inflation. This is what they said. It's anyone's guess what the impact is going to be on volumes due to all the price increases. Burger King said, listen, the Whopper is off the discount menu because they're looking to raise prices, offset inflation. We're still seeing supply issue concerns, which is a direct result of inflation and demand and huge demand. Where Intel CEO, that's Gelsing, said the company expects the supply of semiconductor wafer to remain tight at least, I haven't heard this forecast, at least through 2023. What happened to, remember Ford and remember GM? I mean, 6 months ago, we're seeing it get better. Then all of a sudden Tesla comes out and says, nope, we're not seeing it get better. We saw Under Armour, which is a position on our portfolio, come out and say, hey, this supply, it seems like these supply chain issues were supposed to ease, and it looks like they're starting to get a little worse now, which is, surprising to me. For me, we're all anticipating inflation now. We talk about it every day. It's just how far would the Fed have to raise to really control this, because we're not seeing this tail off as expected. And we may see that, but that's what has me worried with some of these stocks, and especially growth names. And we can talk about, some of the growth names that have gotten hit. But, I just see rates continue to rise. I think the Fed's well behind the curve, which I think most people agree. But I think, Goldman just went from 3 rate hikes, I think, in December to 4 rate hikes in January, and now they're expecting 6. I mean, we're talking about months. We're not talking about, 5 months passed. We're talking about just, 2-3 months passed. That's huge. So now we're looking at rates much, much higher, which is going to be significant.
It will. I will take the other side on the argument of the Fed. And I'm not saying you're accusing me of this. I totally agree with you on them being behind the curve. I think that I do think it's priced in. They're going to raise by 50 basis points so 0.5 instead of 0.25, as they were expected a couple months ago. Where I disagree with you on saying they don't have a choice. Frank, you need to lower your standards and your beliefs in humans. You always have a choice, and you can always choose to do the wrong thing, okay? So let's say they should raise, pick a number, 7 times. My point is that I just am not sure that they'll follow through. I hope I'm wrong on that. I just don't give them the benefit of the doubt like I feel like you're doing. Yes, they should. Yes, they should increase tonight. They should do an emergency meeting. You've had a couple of Fed guys on different TVs talking about how their credibility is on the line, which is beyond funny. How you can say that with a straight face.
Bullard came out and said 100 base point hike right away.
Exactly. But again,
not one meeting, but over the next.
And I'm not accusing him of not being vocal and whatever. But my point is that for them to talk about credibility being on the line now just shows you how out of pace they are and how out of touch. So, yeah, we have to wait and see. Like the supply chain issues, you had Triton. Is it one of the container ships? Now I'm second guessing that, but they even said that supply chains on the container level will ease in the second half of this year. That doesn't mean, like you said, Under Armour is still warning about it. Everybody else is still warning about it.
Someone doing a good job, right? I'm not saying they're not, but I'm just surprised that companies that haven't won before,
right.
Under Armour was going through this great, and other companies, and Nike was warning, and Lululemon a little bit, and those companies that have done well, but Under Armour seem to be managing this, and they said inventory levels have never at the best levels since in a decade. But now Tesla warned, and now you see other companies just starting to warn for the first time. It's just, and it hit those stocks. So, to me, it's surprising. But I want to explain really quick of why this is a big deal. And excuse me for a second. That's my cold, but I'm not going to miss the podcast because of that. So I want to explain this, and Daniel's laughing as I'm coughing. So mortgage rates, right? Let's take mortgage rates. So mortgage rates have surged. The 30 is over 4% now, about 4.15. I just yesterday got approved for my loan.
Hey, finally,
Congrats. They told me probably about 5 times it was a done deal over the past 4.5 months. So
let me interrupt, not to spill any beans here, and not to eavesdrop, but man, Frank has been at the office. He's been through the ringer on this, so I'm sarcastically laughing, but good. I'm glad it's finally done. Are you sure it's finally done, or is it one of those hey, wait?
My closing is next week. Fine. This is a construction loan, right? So it's a construction loan where you pay interest on it first, and then it rolls over into a 30-year, 15, whatever I want to choose. So I locked in, which was a good thing, and this is why I kept with this company, because I've never seen this process take so long. 4.5 months. So much so that they had to run my credit twice for the same loan. I've never seen that before. They probed me as if I was Bernie Madoff. I mean, they just kept asking for information, all the information that you would expect. But then as it went longer and longer, they asked me to resend all that information, to update it on a monthly basis. I'm like, guys, I need to know what's going on. I provide all the information. And it took an incredibly long time. And for me, I couldn't say, hey, F off, because I'm locked in 325. And that was only 4 months ago, 4.5 months ago. Now it's over 4. And that's a big deal. And I want to talk to you about that, because when you look at a mortgage calculator and say you have a $500,000 home, you put 20% down, just say, using those numbers, right? So it's a $400,000 loan. At 3.25%, which was 4 months ago, that amounts to about $2,000 a month. If you use the same metrics, but change the rate to 4.15, what it is right now, that's an extra $200 a month, right? So $2,400 extra a year coming right out of your pocket, simply because, rates rose over a 3-4 month period. But that's today. I could tell you, they're going to 5%. And when they go to 5% and you plug that into the calculator, now that's $2,400 a month. So that's $400 extra a month. Now you understand, that's just through a mortgage rate, right? So now you're looking at all loans, people borrowing money to grow their companies, all this leverage that's in the marketplace that you could borrow for almost free. That's going to change. And that's what you're seeing, even for people trying to pick off growth stocks right now, Daniel, where, I said Roblox was a strong buy. It's one of the best companies in the metaverse. So they just signed, who signed with them? It was Nike and the NFL. Right, to build a metaverse. They're going to have tons of companies signing for them, but they warned and said, we're seeing not the expected growth. The quarter wasn't terrible. It wasn't terrible. Still growing 35% and massive market for them, massive market. So in terms of the total addressable market where they can go with this, but the stock fell 20%. Yeah. And that's what you have to worry about, because if you have a growth stock and they just miss a little bit, you're done in this market. You're not going to, there's no forgiveness in saying, oh, this is one quarter. They did that with Disney and said, oh, you know what? Forget about them earning this in 2022. They're going to earn that now in 2023. I've never seen that ever, but it was just funny. Oh, no, we're just going to push everything out and maintain all of our numbers. They're just not going to be this year, going to be next year, right?
Yeah.
Which is kind of funny when you think about it. But, for me, I just don't feel like this is priced in like a 5% 30-year and the Fed, raising super aggressively. And again, you and I will disagree on this, but the Fed's not going to have a choice. They can't say, oh, they're not going to do the right thing. They have to. Like right now, they were saying they try to push it. Remember, 2% was the benchmark. It was 2%. We're going to raise rates. With 7.5%, you still haven't raised them, right? So it's incredible. Still flooded the market with money over the past year, even though earnings are at record highs. Everything at record high, all asset prices, household net wealth is at record highs. Everything at record highs, right? And you still kept flooding the market with money. Now you're going to be taking that out. The Fed's stuck in a tough place, and you're hearing, like you said, I mean, a lot of these governors are coming on and they're saying, listen, we're really behind the curve here. Maybe it's factored in. I mean, stocks are doing relatively well right now, but I don't know what the upside is here, because, maybe we see inflation subside and that could provide upside. But I think, like, if you're looking, where's the next move going to be? It seems like it's going to be the downside to me. And I hope I'm wrong on that, because I know most people are long stocks.
I understand that. I want to ask you a little bit of clarification on the housing thing. So those are great numbers, by the way, and I believe that. The $200 a month, I don't think is going to deter anybody on buying a house. I think that the tailwind, boy, do I want to get off topic on the mask mandate thing. We'll talk about that in a minute. I think the tailwind and the momentum behind housing is very strong. And I was talking to a business owner out in Arizona who does custom pools and landscaping and things. And a little bit about this, going through the housing project or the home builders thing, and you're going to do your backyard or however you're going to choose. The market for those, everybody on the lower income side, and remember real quickly here that the gap between rich and poor is influenced by the Fed, which is why I have no faith in them, Frank. $200 a month, I just don't think is going to, I don't think people are that up against the red line to where it's a make or break. No. $400, I think that starts to get attention, yes. But I'll even offer, I don't think that's going to deter anybody. I think that the idea and the mentality of people getting out or wanting to move and have their own home is so powerful that'll do it. And to your point with lumber prices recovering, yes, they peaked and then fell and now they're back on the rise. I would really, if you see the headlines around mortgage rates rising, causing Toll Brothers and different housing stocks to fall, I would really have a watch list ready to buy on those because I do think that strong momentum. I don't think those increases on the monthly side are big enough yet.
Yeah, and just to
and I'm not saying you're saying, hey, sell housing stock. I'm just
no, I'm not saying sell.
That's a lot of good stuff.
I'm not saying sell housing stocks at all because even from my builder, I said how's business? So rates rising. I just met with the design center last week, and they said we're more busy than we've ever been in the history of a company.
Absolutely,
and I've heard that from several builders. So. When does it matter? Right now, I could see it not mattering, but it's all about sentiment, right? Because now if you're looking at your portfolio, and a lot of people's portfolios have gotten hit, right? Because you had aggressive stocks in it, and even though the market's doing okay, still NASDAQ I still think is more than 10% off its highs. You probably have stocks that are down 20, 30% in your portfolio that got nailed. Even good names got nailed. So when your portfolio is going down, all of a sudden you're looking at your net wealth and going, wow, it was worth this, and now it's not. And then you get interest rates going up. There is going to be, a point where you're going to be like, holy cow. Gasoline prices I was paying, in Florida, it was, $2.80 and it's $3.60 now. So, it gets to a point where you're like, holy shit, where you see these prices. But, for that, I don't think it's priced in. A lot of it where the market says it's priced in. I hope I'm wrong on that, but I want to see inflation subside. We're not really seeing that. We're not seeing supply chains get eased, which we expected months ago. Now Intel's like, we're going to have problems with 2023. The car companies are not saying that. That's telling you that most EVs aren't going to be launched in 2024. There's supposed to be 53 to come out this year. There's no way that's going to happen. They're going to talk a big game, and they're going to say, well, orders are through the roof because people have to put like $10 down to buy freaking EV just for now to lock it in. But at the end of the day, you're going to see other EVs coming out, and you're going to be like, you know what? I'm going to take the $10 back or the $100 back, and this is available now. So, there's going to be a huge race out there, and, there's going to be winners and losers there, but not everyone's going to be a winner in that industry. Anyway.
I'm having fun with you. Intel's just saying that because they just made a $6 billion purchase, and they want it to be, supply chain issues helps them.
I know. Intel's all over the place, though, right? It's like every other quarter, it seems like,
hey, I like that CEO,
back,
though.
And then it's not.
I like that CEO. He's moving up a lot, he's moving around a lot, I should say.
No, I hear you. So I want to say, go ahead.
Oh, well, we were talking about growth stocks. I do want to talk about one growth stock that has gotten hammered because you brought up Roblox. And so we've talked over the past couple of months, and as we're seeing this transition of high growth stocks getting sold off, this rotation into value, I've talked about this in the past. There's a company called Upstart, and they're an AI, artificial intelligence platform. They provide platform technology to banks for lending services and things. And it's easy to categorize, Frank, here. So what I want to try to do is separate. We're not saying we don't want to paint with too broad of a brush. Yes, the market is selling off high growth stocks. Upstart has gotten absolutely smacked. I don't know if you're pulling that up over there. UPST, Frank, if you can.
Yep.
And you can look at this chart that has gone from, let's call it 100 to 400, and then 400 back to under 100. And it's popping over 20% today, or at least it was a few minutes ago. I say all that because I'm not saying the sell-off is over, volatility is going to continue, but this is worth looking at right now and putting on your watch list for a couple of reasons. One, this is a high-growth stock, but it's not a broke high-growth stock. So you have your category of high growth, no earnings. Those are going to continue to get punished as interest rates continue to rise and anticipate rising further. This company is actually profitable. Still trades at a very high PE, so I'm not attacking you fundamentalists out there. I think the PE is still over 40. I don't know if you have that up. I think at the price to earnings, forward PE is about 40 times, which is,
It says like 60, 67 times.
Okay, well.
But they just reported.
Yeah, they just reported solid earnings. So let me throw a few numbers at you here. And remember, they are profitable. High PE, but stay with me here. Fourth quarter 2021 highlights. This is year over year to 2020. Total revenue increased 252%. Total fee revenue increased 240%. Mm-hmm. Bank partners originated almost 500,000 loans for $4 billion, and that's up 301% from a year ago.
This price, that's amazing.
Now, remember, this company is profitable. They're not a lender. They provide technology to help lending. And I pulled the conference call transcript. This gentleman, I'm not even going to butcher his name, the founder and CEO, he's an ex-Google employee, big wig at Google, Frank. And I want to point this out. So on the conference call, and this is one of the reasons why we encourage everybody to go through some of these, use the control find, pick some keywords, enjoy this, dig into these companies. He says in the conference call, I'd like to start by reflecting on 2021. We grew revenue from $233 million in 2020 to $849 million in 2021. Mm-hmm. That's a hell of an increase. Yeah. He goes on to say all this kind of stuff. But his vision, here's what really stood out to me, Frank. They're going to get in from personal loans, their addressable market as they get into autos, and everything else. And he references, hey, we're about the same size, $8-9 billion company that Google was when I started there. And he talks about having this vision to be the disruptor in the main space, and Google and Amazon, and those are his North Stars. But he talks about the total addressable market that they're over, then this is over several years, is over $6 trillion in origination for loans. Now, what this product is doing, Frank, and they're proving this, is saying, hey, banks can use this to give more loans for less default rates. And they even, but my whole point to say, and I don't want to come across too much as a cheerleader, because again, I'm not ignoring the fact that this stock got wrecked from 400 down to under 100. My point to say that is that these are the kind of companies you want to look for, because yes, they're the high growth, high priced, but if they can grow into these, that's going to be a hell of an opportunity. And when you go through and look at these numbers, Frank, let me ask you as a growth analyst, if you're trading at 40 to 60 times earnings, but you're growing profits and net revenues by a few 100%, you can make the argument that's not crazy. Doesn't mean it's a guarantee for this environment.
People make that mistake, and I'm going to make that clear. And I make that mistake. I made that mistake early in my career where I didn't buy Netflix. I didn't buy Apple when it was trading at 60, 70 times forward earnings, because I'm like, that's crazy, because I didn't factor in that growth. But yeah. Yeah.
And so my takeaway here is put Upstart on your watch list at least. If you wanted to buy some and gain exposure to this, I would start with the third position or so. But man, when you see, we've talked about, Frank and I are on this big macro theme of stock pickers market, and you want things to trade on their own fundamentals. That's not to say that if the market drops, this company is going to get hit hard. I'm not saying it's proof. They also announced a $400 million share buyback. That's why one of the reasons the stock, on top of the great earnings and growth, $400 million in buyback shows you that the management team is thinking about how to run the stock price as well as the company. Not to focus on that I don't want to get crazy on that, but you want to see leaders that have been there and done that. He's been at Google. He's got a great story. That's the kind of stuff you want to look at in a crazy environment as an investor, because this is a great company that earns money in a high growth area.
Yeah, no, good point.
Frank, why don't you stop me when I get on like that?
No, I like it. Keep going, man. It's cool. Another company that just reported, I found interesting really quick, and I don't forget the 13 apps. Maybe we'll do that next week. A lot of them, that's when all the money managers, over $100 million in hedge funds and stuff that manage, they have to report their holdings for the month, for the quarter. And it's interesting to see, what they're getting into and what they got out of, a lot of window dressing there too and stuff like that. We'll cover that, I think, next time, because I wanted to talk about one more stock here, which is Crocs. When I bring up a chart here of Crocs, I mean, you're looking at, obviously the stock has went up from its lows here in the COVID lows. It was like $10 and it went to $175. But if you look recently, and this is just the past couple of months since November, again, it's you can see this. We were showing the chart on the Curzio Research YouTube page. It went from 180, now it's 96. And it's cool to see that a company, I mean, even though you'd think that they would increase their share buyback, they came out, they reported decent numbers, which is okay. They announced that they're going to suspend their repurchase program, which I think is really cool. I mean, you don't see a lot of companies do that often, and instead they're going to focus on lowering debt. So they want to keep their gross leverage under 2x, which is above that right now. But a lot of companies don't announce that. I thought that was really interesting, and I kind of like that move. And with stocks higher and risks to the market, I wonder if we see, the buybacks. And you never really have to say you're going to suspend your repurchase program, because when you launch a repurchase, when you say we're buying back shares, it's interesting because you could announce you're buying back 20% of your float, and this is something you could announce, and you'll announce a time period over the next 12 months, 18 months, 2 years, but then you could pull it back. You don't have to do it,
right?
Which is kind of weird, right? Because you don't have to do it, and they'll monitor it every quarter, and they'll mention how many shares they bought back, and the analysts cover this stuff. But you're not like obligated. You're not like locked into doing that. So a lot of companies would be like, okay, we're just not going to do it or whatever. But to make that announcement, I thought was pretty cool being up front. And I think Crocs might be a buy down here. Cut in half. The numbers are still really good. I like they're focusing on debt. Demand's through the freaking roof. But yeah, I guess, this stock is down. I was just surprised to see that. That's something you don't normally see. And I kind of like it. I like the transparency there. More transparency is always good for stocks, and less is always bad when you have that uncertainty. So I thought that was pretty cool.
Absolutely. I agree. I think what stood out to me with this, when you mentioned this, again, playing on the theme of stock pickers market, you want good operators, you want businesses. And this is the great example of trading versus investing. If you're an investor in this company and you're buying shares because you believe in this story and you want to compound your money over the long term, in my opinion, this is exactly what you want to see in a management team. You want them to address debt. It's not always easy. Like you said, it's down 5%. Their guidance was basically in line with the street. There's plenty of wiggle room there. It's not like they came out and lowered a lot. But if you have a management team that is focusing on getting its financial house in order, you have anticipation. Everybody knows interest rates are going to go higher. So as debt comes due, if you're going to refinance that debt, it's going to be at higher interest rates, which means your interest payments are going to be higher. Just to your point about mortgages, it's the same thing for businesses. So as a management standpoint, this is great. Or I'm sorry, from an investor standpoint, this is what you want your management team focusing on. They just made a huge acquisition. Bring it in. Now they're going to all sort it out. And I think that's a good idea. This company is crazy because of how volatile it is. And even though after I just talked about Upstart, I've never paid attention to this, but I would follow you in on here. I like that with the management team, and this should help put a floor under the stock. And barring anything crazy or an absolute bear market, I like that move. I think investors should cheer that.
Yeah, no, I agree. I love the transparency there. And this is a stock that, again, if you have kids, I mean, Crocs, everybody. It's just such a massive stock. And huge demand. So huge demand there. They had a pretty good quarter. They lowered expectations a little bit, down 5%. But, this is a stock that really got nailed that I think is really doing the right thing. That could be a buy and you should put on your radar. Now, last topic here I want to talk about, and we hinted at it, right? The reopen trade is live and well, Daniel. This is where you can make a lot of money in the market right now. The CDC just lowered the cruise ship COVID-19 restrictions. It's like, DEFCON 1 to DEFCON 2, whatever it is. I don't know if 1's the worst or 5's the worst. I think it's DEFCON, what is it? I forget which one it is. From War Games, that's where I get it. Anyway, but they lowered it to a very high level to just regular high. And they're easing, that's the point. So Disney just came out and said masks are now optional, which is massive. Massive, massive, massive. Especially, I've been to Disney in Florida. When it hit to summertime, it's always over 90 degrees there. Wearing a mask was unbearable. You feel like you're going to suffocate. I mean, it definitely hurt. That's huge. Vegas, no more masks indoors. Another thing that people hate when they go to Vegas, right? So now if you're looking from a political angle, right? And I'm not saying this to this is about stocks, okay? So don't go crazy and send me emails on that. But if you're looking from the political angle, Democratic states have more COVID restrictions in place, right? That's a fact, right? So polls show that people are sick and tired of this shit, right? They're done with COVID. They understand that people know the risks. They know who needs to wear a mask. They know who needs to be vaccinated, be protected and stuff. We know, right? But a lot of people are done with this shit. And now we're seeing a massive push to pull back all these COVID restrictions in a lot of these states and these areas, even in New York and stuff like that, in California. And ahead of the midterm elections, right? Because that's a big deal. It's a big selling point. So, regardless of what you think about that or whatever, you're seeing it across the board. You're even seeing it in international markets. It's great for reopen names. It's great for casinos. When Las Vegas Sands have exposure to China, Wynn is more China than Las Vegas Sands. MGM has exposure to China, but I think that's more Vegas. Red Rock Resorts is a company in our portfolio that's done fantastic, right? We really almost bottom ticked that during COVID, and this is more off-strip, they own off-strip properties. And Dan, you talked about Red Rock Resorts. You brought up an interesting stat, which reported. Again, that's in our Curzio Research Advisory portfolio, right?
No, it's in Curzio
Venture Opportunities portfolio. See, I forget sometimes because it was actually that small. Actually, the market cap came down so much, and all these stocks got hit. We're like, we did put a couple of well-named stocks in there during COVID and kicked ass. But
we hit that out of the park. And the way we came across that, firstly, if I'm not mistaken, is that we saw insiders buying that, and we kind of just flagged that and then started to dig into it and realized that, hey, local communities in Vegas will come back before the main strip, obviously because of restrictions and travel and things that were in place at that time. One of the stats that stood out to me, I was going through their conference call, and I don't have it in front of me, so take this with a grain of salt. It's like a poll, plus or minus. But they have between 2019 and 2021, I believe the number of households that had moved to Vegas, because as you have people moving around and the demand there from lockdowns, the amount of households that were making over $100,000 or more per year grew almost like 20%. Mm-hmm. And through 2026, it's supposed to grow at basically a compound annual growth rate of 6% to 10%. I thought that was geared more towards younger. I don't think that was correct, Frank. But my point is that you have higher income earners, because what's the average? 60-ish, 50, 60-ish? I don't know if you take the average of the household income, but it's probably under 62 if I had to guess. Mm-hmm. So Red Rock pointing out that, hey, we have families making $100,000 or more moving in at a high pace. They're going to capture some of that market share at their casinos and things. That's a huge tailwind, in addition to, like you said, this mask mandate, which is just investor sentiment. And it's not this hoorah-rah or this genie smoke out of a bottle. you can't argue the fact that when people feel good, just like a wealth effect, when your stock portfolio is going up, you're more eager to do things because it does feel good. I'm not saying that that's the only reason or something to make a decision on. I'm simply saying that's a part of our reality as emotions. If we can get I'll play politics, Frank. I know you don't like to, but you can send your hate mail to me because I'm right on this. Just like they're not passing anything on Build Back Better, you can't pass things too quickly because you want to sell the idea, not the result. If something doesn't go well and you have higher inflation and you've been promising inflation is going to go down, you don't want that result already ahead of the midterms. You want to wait. If I was a Democrat, I'd wait as long as I could to pass anything because then you sell the idea, not the result. And if you're in trouble, all you have to do is release or remove the mask mandate in schools and airlines leading up to the elections to give a more boost to sentiment. And that will happen if they need it to on the poll side.
Yeah, and Red Rock Resorts, we recommended it in August, and I'll give another one away here because we're up a lot on, but Hilton Grand Vacations, that's what we were saying. Listen, this makes a lot of sense. These are great names that they're beating up. Red Rock Resorts was under $17, and it's $52 today. So we're up over 200% on that position, and we continue to hold. So, it's... that's just part of it, right? So the main point here, what I wanted to go over is how the reopen trade. You look at Expedia, right? Expedia came out with their results, and Expedia said that trends did improve throughout January, and they said throughout January, right? So January, and we're ahead of 2019 results in most of the recent weeks. That is a huge statement. Mm-hmm. Okay, we haven't heard that out of cruises, we haven't heard that out of airlines, and we haven't heard that out of these companies. That we heard that they're getting much better. Remember that? I mean, revenue was down 80-90%. They were shut down, no flights or no nothing, right? Everything was shut down. Then it was like, hey, 50%, 40%, 30%. We haven't heard that. And Expedia just came out, and this is without international travel. This isn't out business, so it shows you the pricing power these companies have. Earnings are about to explode for these names. You saw Expedia report; they were great numbers. Airbnb, Priceline. You're looking at airline bookings for this year are exploding, especially international. Most countries, again, rolling back those COVID restrictions. We're going to look at business travel start coming back later this year into 2023. And one stat that, Daniel, you're going to love, I guarantee you're going to love this. I don't know if you know this.
Right.
Southwest bringing back booze in the spring to their flights.
Oh, I do like that.
Holy cow, first company to do that. I know that's a big, big selling point for you.
It is. I'll have to check Southwest price tickets.
Yeah, but it is.
Not being able to drink on an airplane is terrible, people. That's a dumb idea, especially for those of us like me that are scared of flying.
Yeah, that's the thing. A lot of people are scared of flying, and they do like to have a drink. I hear that from a lot of people. I mean, people are just scared of flying. But to see... The bottom line is everything is getting back more normal, right? When you see Disney, absolutely. Especially when you see those establishments, Disney was really like aggressive. Vegas was really aggressive. I've been to Vegas in a consumer electronics show, and holy cow, it was, wear your mask, wear your mask, wear your mask, wear your mask. It's just, but now you're dialing that back. I think you're going to see airlines pretty soon say the same thing, where, hey, they're optional, meaning if, hey, you're over 60, you have underlying conditions, wear a mask. You should wear a mask, but everybody know, especially in an airplane where, the air is amazing. I would say the terminals you'd probably have to worry more about. The actual airplane, that air just keeps getting refiltered, and it's amazing. I know a couple of pilots that actually, tell me all about that. And that was over a year ago. But you're looking at that trade, and I think there's a lot of money to be made here. These companies are just beginning. I would say they're in the third inning right now. If you were in early, it was great. Then Delta hit, and then Omicron hit, and you're like, holy shit. But again, when we recommended these things, we said, look, eventually this is going to go away. And when it does, these companies are going to explode because they cut costs tremendously. And now you're looking at demand coming back. And with that pricing power that they have, and people have more money than they've ever had, and people dying to travel right now, holy cow. There's so many of these names, especially airlines as well, which I've been pushing for a while. Now you're really starting to move higher. I think now is definitely, if you haven't gotten in this, it's still early to really get in these names. I think that a lot of these names are going to explode.
There's a lot of money to be made on that. And if you're nervous about gaining exposure to that, just start with a smaller position size, but definitely have some exposure to this to benefit as this unfolds, because there is a lot of momentum behind that. And that will definitely help fight off higher inflation fears in the short term. Absolutely. I definitely believe that.
Last point here, it was what Daniel just made. It's extremely important. Every one of our positions in our portfolios, we're taking either a third position in crypto, which, listen, was a great move. A lot of people came in when crypto was higher over the past 3 months, and crypto crashed, and now you've seen it rebound, but we added to these positions because these are really, really good names that we like within crypto, because there's a lot of shit. 90% of the crypto market is shit. There's utility tokens. There's no utilities for some of these things. Again, I analyze over 1,000 of them now. And you're seeing us, you've seen these names come back. even now, you don't know what's going to happen with Russia, and I covered that yesterday, and got a few emails. It's not that I'm pro-Russia. I just think that Ukraine could really, I think it's in Ukraine's hands to really make sure that they're not going to get invaded or to stop this thing. It's not really Russia. Russia said if you do, look, I covered it yesterday. Again, I want to sound like I'm pro-Russia. I'm just saying I wanted to provide both sides of the story because here we are saying that, Ukraine's this nice, innocent little country that's, hey, stop bothering us and stuff. And, it's not like that. Like, there's a reason why Russia right now is really, really coming after them because they're doing shit that Russia said in 2013, don't do, or we're going to have problems. So, hopefully that eases the situation. But you don't know what's going to happen there. You don't know if the Fed might get a little crazy if these numbers go nuts. Maybe I don't think they'll go 75 basis point hikes, but let's see. They might go 50 and said, listen, we're going to be really, really aggressive the rest of the year. You need to pay attention to that. Start slow, small positions, and add over time. I think that's the best way, right?
Yeah, absolutely. Because you don't want to hinder yourself or get so caught up in headlines and short terms to not do anything. Inaction is not what you want. You want to have exposure here. You can limit that, but definitely have exposure to this because the stock market still generates amazing returns, and you want to invest alongside capitalism while we still got it.
Definitely makes sense. So, guys, that's it for us. Thanks, Daniel, so much for coming on.
Cheers.
Questions, comments, feel free to email frank@curzioresearch.com. That's frank@curzioresearch.com. As I always say this, really appreciate all the support. And I'll see you guys tomorrow. Take care.